Welcome to Caribbean Business Review, where insight meets impact. We bring you economic and financial updates, sharp statistical breakdowns, and data-driven insights on the forces shaping the region. Smart analysis, bold ideas, real Caribbean intelligence. This is CBR. Welcome to episode 11 of season 2 of the Caribbean Business Review. I'm Joseph Cox. Now, thank you as always for your continued support across all our social media platforms and on MKR Radio. Our special guest this week is Dr. Devon Gardner, Senior Partner at the Institute for Innovation and Growth, as we discuss rebuilding Jamaica's power grid post-Melissa. And in the CBR briefing, we examine rebuilding Jamaica, the hidden risks inside the new National Reconstruction Blueprint, what this model gets right, where it is vulnerable, and what global best practice demands from a reconstruction authority with this level of power. And as many of you saw in the press release we issued at the weekend, we have also launched CBR Intelligence Notes, our new midweek analysis series that provides deeper data-driven insights on the issues shaping the region. Look out for the first edition this Wednesday. But before we get there, a major development deserves attention. Now, MegaMart in Montego Bay, a 75,000 square foot retail anchor employing 165 people, has confirmed that while the store is not permanently closed, it will remain out of operation for an extended period after 8 to 10 feet of floodwater devastated the facility. CEO Gazan Azan Jr. has not provided a reopening date and has not ruled out a timeline of up to 1 year. A shutdown of that length is a structural hit, and it signals something deeper. The damage across Catherine Hall, West Green, and surrounding corridors was not only severe but transformative. As hydrological and geotechnical assessments continue, a difficult reality is emerging. Some of the hardest hit areas may now be classified as high risk or even no-build zones. For businesses trying to plan their next steps, that uncertainty alone is destabilizing. And the implications extend far beyond construction. If key commercial districts are designated high risks, insurers will reassess exposure, premiums will rise sharply, and some firms may struggle to obtain coverage at all. For SMEs already operating on thin margin, that combination, physical damage, zoning uncertainty, and tightening insurance conditions, will determine whether they reopen, relocate, or exit entirely. MegaMart's extended downtime is therefore not just a single business story. It is the first major signal of the commercial and financial pressures now confronting Western Jamaica. The question ahead is how many firms can survive the next phase and what the new economic map of the West will look like. With that reality in mind, let's turn to the stories we are tracking this hour in Market Watch and Global Pulse. Coming up in the Market Watch, Fitch revises Jamaica's outlook to stable, Antigua and Barbuda unveils strong growth, and Barbados beats mid-year revenue targets. Then in Global Pulse, U.S. jobless rate rises to 4.4%, Canada's inflation slows to 2.2%, and Japan posts first GDP contraction in 6 quarters. All this and more this hour on Market Watch and Global Pulse. Coming up next, it's a CBR briefing. This is a CBR briefing. I'm Joseph Cox. Hurricane Melissa has delivered the largest damage bill in Jamaica's modern history, with losses now estimated at $8.8 billion US. In response, the government has announced a sweeping reconstruction framework anchored by a new central authority, the National Reconstruction Resilience Authority, NARA. It is ambitious, decisive, and given the scale of destruction, clearly needed. But an authority with exceptional powers also brings real governance, fiscal, and social risks. And if Jamaica is to rebuild stronger and rebuild equitably, these risks cannot be underestimated. Today's CBR briefing distills 5 structural risks Jamaica must manage carefully, along with the global best practices that can help avoid missteps. 1. Centralized power without clear boundaries. NARA will sit above ministries, municipal corporations, and line agencies. fast tracking approvals, procurement, and project execution. That can dramatically improve speed. But centralization also creates accountability gaps. When one body sits above everyone else, responsibility becomes blurred. With billions flowing through a single authority, decisions around project selection and sequencing becomes vulnerable to political influence or even the perception of it. Countries that got this right: Japan, New Zealand, and the US after Katrina paired centralization with independent oversight, transparent reporting, and time bound powers. Jamaica must do the same. 2. Procurement risks and the EPC problem. Government signals point to the use of engineering, procurement, construction contracts, or EPCs, where a single contractor manages design, procurement, and delivery. EPCs move fast, but globally they come with serious risks: cost overruns, reduced transparency, weak price competition, contractor dominance over the state. With reconstruction costs potentially rising far beyond the 1.15 billion US in immediate liquidity, Jamaica cannot afford opaque contracting. Best practice demands competitive tenders, mandatory publication of awards and variations, and strong local content rules so Jamaican contractors and workers are not sidelined. Speed matters, but speed without transparency multiplies risks. 3. Housing, social stability, and the politics of relocation. Now, government plans include modular container homes, shelter kits, roofing support, and repair grants, all vital. But distribution of relief and housing support is highly political. Who gets what, when, and can shape perceptions of fairness or bias. A deeper challenge is relocation from no-bill zones. Moving households out of the floodplains and storm surge areas will shift populations across electoral boundaries. That can change constituency balances and trigger political resistance, even when the technical case is clear. If relocation is not grounded in transparent hazard maps, clear eligibility rules, and community wide relocation plans, Jamaica risks backlash that slows reconstruction. There is also an emerging tension with local government. Parish councils depend on building fees to fund basic services. If NARA fast tracks approvals without a revenue sharing mechanism, parishes could lose income and authority. These issues must be resolved early. 4. Fiscal pressures and the need for a reconstruction financing plan. Jamaica has approximately $1.15 billion available from the CAT bond, CRIF, contingent credit, and the IMF RFI. But if government must absorb even half of the $8.8 billion US dollar damage bill, the financing gap is large. This creates a three-way tension between speed, debt sustainability, public confidence. Countries that navigate this successfully publish a reconstruction financing plan outlining what gets built first, how it is paid for, and the impact on debt. Jamaica needs that clarity early to protect fiscal credibility. And 5. Institutional legacy, stronger or weaker. NARA's mandate is temporary, but its legacy will shape institutions for decades. If ministries retreat and NARA becomes the sole center of competence, the state ultimately becomes weaker once the authority winds down. If NARA builds capacity, standardizes systems, and modernizes processes across government, Jamaica exits this crisis with a stronger public administration. The legacy must be more than roads and houses. It must include better procurement discipline, climate resilient planning, and stronger institutions. Reconstruction on this scale is once in a generation. Done right, it can reshape the country's resilience, architecture, and strengthen governance. Done poorly, it can deepen inequality, strain public finances, and erode trust. As Jamaica begins this journey, the biggest risk is not the size of the bill, but the quality of the decisions. Now that's your CBR briefing. The This is Market Brief. Jamaica, in response to Hurricane Melissa's $8.8 billion US damage, has activated $1.15 billion US in immediate liquidity and launched a reconstruction entity, NARA, to fast-track rebuilding, debris clearance, and housing support. Fitch Ratings has affirmed Jamaica's BB- rating, but shifted the outlook to stable, citing a projected 1.5% contraction in 2025, weaker fiscal balances, and debt rising towards 68% of GDP by end 2026. Saturn reports inflation rose 0.7% in October, while BOJ moves to modernize financial access with a national eKYC platform. Barbados has surpassed its revenue targets by $373 million, led by strong VAT and corporation tax. The Cayman Islands has announced $172 million in new fees targeting business licenses and immigration. Antigua and Barbuda projects 7% growth fueled by record tourism and major infrastructure investments. Turks and Caicos is tightening contractor rules with a new bill requiring 60% belonger ownership, and Bermuda has strengthened travel rule compliance ahead of FATF assessment. Grenada has amended its Fisheries Act to avert a U.S. export ban, and Caribbean CIP countries face elevated scrutiny as the EU adopts tougher visa-free suspension rules tied to security risks. Now that's your 90-second market brief on CBR. I'm Joseph Cox. For more, look for us on YouTube and Spotify.
In a world of constant change, insight is your greatest asset. At Joseph Cox & Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox & Associates. Insight, experience, impact.
Still ahead on Caribbean Business Review, our conversation with Dr. Devon Gardner, Senior Partner, Institute for Innovation and Growth, as we discuss rebuilding Jamaica's power grid after Hurricane Melissa.
There to be assessments and undergrounding of some cables and strengthening of some substations, raising the height of some substations that are coastal as a case in point, to avoid storm surges, strengthen the structures and reinforcing structures, rebuilding in some instances some of those that have been significantly compromised, putting in the kind of ICT and the kind of digital technologies that will improve intelligence and make the system a lot more.
Okay, welcome back to Caribbean Business Review. I'm Joseph Cox. Today we're going to be talking about the electricity, and frankly speaking, in parts of Jamaica, I suspect the argument is a complete reconstruction of the grid. Now, to help me to understand some of the issues is a senior partner in the Institute for Innovation and Growth. Devon, welcome back to the program. Okay, you're no stranger here.
Thank you very much indeed.
Yes. Now the question I wanted, where I want to start with, we had Hurricane Melissa in Jamaica. Sustained wind speeds of 185 miles per hour. Wind gusts, verified wind gusts of 252 miles per hour.
Yep, highest ever recorded.
Now, my question, I suppose, is two-part. One, which part of the grid? Because it affected primarily the western side of the island, if you will, right? But the question for me would be, which went first? Was it the grid? Was it the distribution lines, transmission distribution lines, or the or the substations? What went first in this kind of dynamic? And I suppose the second part of the question, Devon, would be, what does all of this information tell us about the wind load factors of the basic infrastructure that we would have in place for electricity?
Yeah, thanks, Joseph, and very good question. Again, one of the things that is important is that we have to spend some time to do the detailed assessment, because the way how JPS works or any utility in that regard is that you usually start with a high level assessment, pretty much that is based on a recovery effort. And that initial recovery effort is based on a restoration of service, to customers as far as is possible until you get to eventual full restoration of services to all customers. So in that instance, it did the detailed assessment is something that is not yet being carried out. The detailed assessment is something which is following as that goes along. They happen in parallel, but usually the priority is on restoration. And while that restoration is happening, then the assessment follows behind. JPS has reported just yesterday that they have completed close to 100% of the assessment. And so we are looking forward to getting some details on that assessment. And once we get details on the assessment that JPS would have concluded, we will get a better sense as to really where the initial points of failure were and what would have caused the cascading of other failures that were linked to that. It's kind of like forensics. You have to piece it together to understand really how the whole system fell apart. What is clear is that it's not just the transmission and distribution system that fell apart, but some parts of the power generation. In terms of the solar, you would have heard that the Paradise Park suffered significant damage also, and will require some amount of repowering. Lots of the solar panels and the racking systems that come with that, and other parts of that infrastructure, including wiring and so on, would have gotten damaged. So a significant amount of repowering will happen there. In the case of Wigton, which is the wind farm, there was also some minor damage through the first phase of Wigton in Rosehill. Of course, the major issue that Wigton faced was more the transmission line that connects them to the system. So they were for a while offline, and they are still now beginning to come back online. So there was also some parts of the generation that would have suffered based on the situation, especially with Paradise Park, which, as you know, is a significant amount of the renewables, contributor of the renewables to the system. So we know that the generators got affected in terms of the solar and small amounts of the wind. We know that the transmission backbone in the western side of the country, certainly Manchester, St. Elizabeth, Westmoreland, and parts of St. Ann and Trelawney got damaged significantly. We know that the distribution lines got some significant amount of damage. And of course, the substations associated with the transmission and distribution system, of course, some of it flooded, some of it because of roofs lifting off and that kind of thing. And infrastructure integrity of the structure integrity being compromised. And we also know that some of the lines, we know what happened with the buildings. We know that it's reported that over 120,000 buildings were damaged in the hurricane.
No, man, you're wrong. Give you an update, it's 146,000.
146,000. Well, I said over 120,000
completely destroyed.
Yeah. So I said over 120,000. So yeah, I was on the cautious side. So yes, close to 250,000. And people sometimes forget that, the buildings are a part of the power system, because at the end of the day, that's the end use, that's where the power is going. So when you disrupt to that end use and, the loads that are associated with the power, that will affect, obviously, how it is that everything comes together. So the system itself is a total system, and we have to understand that. So what I would say at this point is that, one, we know that there is around close to $3 billion worth of infrastructure damage based on the existing infrastructure. The estimates are that probably around 40% of that is due to the power infrastructure. Two, we know that the transmission and distribution system would have suffered significant amount of damage, and that includes substations. And we know that the JPS and its another assessors in the region who have been supporting them, including the World Bank and so on, are now concluding the detailed assessment that would allow them to begin to figure out exactly how the damages would have occurred. 3, we know that they are working towards full restoration. We know they have gotten to probably around 71%. They have reported of customers restored, around 29% left to be restored, and significant amounts of their critical load they have said are back online. As I think they said that at least 60% of the critical customers are back online. And so with the restoration moving well, what that will do is give them time to do the more detailed assessment and do now the recovery part of the thing, because we have to remember that restoration will always take precedence over the recovery, because people need to be back online and people need their services to function.
Great.
And then once that is happening, it will allow the utility now to really sit down, look at the numbers, look at the system properly, do some of the administration. There's quite a lot of administration, and I'm sure we'll get into that conversation as we speak today. There's quite a lot of administrative issues that are required. You know, there are the issues regarding the license that they would need to figure out in terms of the electricity license that govern their operation. And there are the force majeure, clauses within that license that they would need to also at some point declare, and that requires the regulator, of course, agreeing, and that force majeure declaration allows for them to recover monies from the resilience fund that the regulator typically earmarks from monies that are collected and they bill. So there are those things that need to happen too, before, while all of the pieces are coming together. So it's really a lot of complex pieces, some of it governance related and administrative, and some of it, of course, related to the technical assessments and infrastructure assessments. And those things will come together in terms of, what it is that is a recovery plan and a recovery schedule will look like, because the recovery plan and the recovery schedule is going to have to look at what is optimal and then what is realistic, because I try to avoid suboptimal recovery design. But at the same time, sometimes you have to compromise between what is optimal and what is doable. You know, I hear a lot of conversations around the undergrounding of transmission systems and so on. Obviously you have to look at the area we're talking about in terms of the geography and geology of the area, because undergrounding has a lot to do with the location is in terms of what the geology and geography allows for. And also there are other hazards that have to be taken into consideration, because as much as the hurricane poses a hazard on overhead lines, there are hazards that are other than hurricane that can affect a line that is undergrounded. So we have to look at the compromise between what's the hazard when the line is overhead versus what are the hazards for lines that are underground. So, it's really going to become a balancing act.
No, but as you say it, I'm curious, because one of the things that has emerged is that the water table in a number of areas is clearly has risen considerably. And I'm wondering to what extent, when making that sort of determination as to whether or not you're going to have underground cabling versus overhead, I'm wondering to what extent what we are seeing emerging now, which frankly speaking, I don't remember ever seeing that sort of development before. I'm wondering to what extent all of that makes the conversation almost moot, and whether or not we might not just have to go right back to the status quo.
Well, I mean, the truth is, the technology is, for insulation is quite advanced, and so water is not an issue in terms of undergrounding. With the right kind of insulation, you can put cables underground that can withstand water and saline intrusion and those kind of things. So you can protect your wires, right? The issue though is that the requirement for protecting the wires, meaning the amount of insulation that is necessary for the wires to be protected, makes it extremely expensive. So the more you have to protect your wires against, the more expensive undergrounding becomes, and so it becomes a matter of economics. If it is that undergrounding is going to be something that is going to be paid for by the ratepayers, which is typically what happens when you make investments in the electric utility. If it is that there's an investment in utility assets based on the current structure of the power sector, it is ratepayers who pay for it. So if if those costs are going to find their way into the rate base and become part of the utility rate for that is already high in Jamaica, then I could see it being a problem for customers, because at the end of the day, we'll have to look at the trade-off. So what is the frequency with which the probability with which the country and certain parts of those islands will get hit with the kinds of systems like Melissa that would tear down the entire overhead lines, the entire overhead transmission architecture, compared to the cost that it will take to underground it for probably a once in a 10-year, once in a 20-year event. If one of the things I've always said in a lot of my conversations in the past, you recall, Joseph, when I was at the CARICOM Secretariat as head of the energy unit there, was that there is need to treat the utility grid as a public good, and similar to what you do with roads. And so there has to be means through which some aspects of the utility grid is funded through the public purse. Now, in this instance, the expectation is not that it will be funded by the national public purse, because of course Jamaica doesn't have that kind of money. But because of some of the relationships and links that the hardening of infrastructure has to do with climate-related events, the view has always been that there should come a time, and I think this is the time, when some of the investments that are necessary to harden the system is coming from global climate adaptation funding. So that the cost of those investments do not find itself into the rate base, because, as I said, it's expensive if it is to be done optimally. So you're looking at undergrounding infrastructure that could include lines and and in some instances transformers and so on. And then if you start to look on some of the other things that need to be done, like digitalization of the system, you would start to look at smart meters and some of the IoT type solutions that are necessary to make the system a lot more flexible. Because you do more than the undergrounding and the hardening, what you get better performance, the way to get the best performance of the system is through flexibility. If the system is flexible, you actually get more out of it than just hardness. Does a sheer hardening of infrastructure. And flexibility in terms of how the system operates, meaning building several lines that can give you redundancy pathways through which you can move power from one place to the next. Putting the systems that can, putting in the kind of ICT and telecoms structures that will allow you to be able to do fault detection and fault isolation, automatic fault detection and fault isolation. So you are able to do a lot of things without necessarily having to disconnect large swaths of customers from the system, by really compartmentalizing those areas that are affected in small pockets. So it's going to be a lot that can be done. Opportunities to make the system better. There are a lot of options there. And the question is going to have to be, which of these options can we afford to do in a way that is reasonable based on the kind of risk which the system faces?
Well, that's a realistic take on it. But one of the things that strikes me, though, does there exist any electric infrastructure, frankly, that could withstand that level of wind? 185.
No. I can't say. I can't. You don't even have to finish answering this question. No. The point is, you have the eye wall of Category 5, one of the strongest Category 5 hurricanes, passing directly over infrastructure. There's not a lot of infrastructure, and even in the more advanced and rich countries, as you would see in the US a lot of times, they don't build to withstand that kind of pressure, because you don't deal with that kind of pressure on such a regular basis. And yes, the undergrounding will hide some of the infrastructure from the wind, but there are other parts of the infrastructure which will be compromised and which would be affected nevertheless. So if you are going to hide all of the transmission infrastructure, the Jamaica will not be able to afford it. If you are going to hide some parts of the transmission infrastructure, yes, that makes sense, right? So we really have to do the assessment and understand, where is it that you have the highest frequency and risk related to hurricanes hitting the island, and relative to load centers You have to look at it relative to the cost amount of customers served by the
Yeah,
transmission lines, as well as the frequency with which that section of the island would likely be impacted by storms and hurricanes. And then you look at the risk vis-a-vis the benefit and then the
yeah,
cost, and you try to balance everything and see which parts would probably benefit from undergrounding based on
the,
the amount of exposure that the infrastructure in that area would have to potential future storms,
yeah.
and the amount of
No, but
customers who would benefit from that investment in terms of the areas which would that those lines are serving. And
yeah,
what it is in terms of cost, again, cost being a function of the kind of terrain and the kind of
of course.
environment that you have to
Yeah.
underground in.
No, but the thing is this, Devon, and this is where you have to also look at it. The country is small. In fact, most of the islands, in fact, all the islands in the Caribbean are small. So I'm not sure you have the luxury of pinpointing and say, okay, this area is likely to be impacted vis-a-vis the other area. Because the truth of it is that for the capital city of Kingston, it escaped with like probably category 1 wins, but the fact of life is that I don't know that, given the size of the country, I don't know that there is any sweet spot you could pick and say, well, here is more likely to get it versus the others. 'Cause, I mean, we take it back to a Hurricane Gilbert in 1988 that went from Morant Point to Negril Point straight through the island.
Yeah, well, there are assessments of the hazards, Joe, that like the climate studies group and Mona and some of the other entities that do work in climate related exposures would have done in the past. So there are some assessments of the hazards, and there are some even within the small geographical space. There are some areas that are more vulnerable than others. Everywhere is vulnerable. Everywhere is vulnerable. So I'm not taking away from that. All of the country is vulnerable. There are some locations that are more vulnerable than others. And so, the question can be asked whether those areas that have the highest vulnerability should probably be, looked at in a way that allows us to be able to figure out whether it makes economic sense and,
Correct.
to spend money on the yard. I always say that one of the things that we use in the sector to figure out cost is really the cost of electricity that is not served. So sometimes it's not just about how much it can cost us to underground the thing. It's really about, okay, what is the value of the load that is lost? And it's usually we use a simple factor to determine that, to say what is the GDP of the country versus the amount of kilowatt hours that is produced for that year of GDP. So that kind of tell you what each kilowatt hour of electricity, to tell you in a very rough way, tells you what each kilowatt hour of electricity produces in terms of GDP. We call it the value of load loss, and we say, look, even though if it is that you're going to spend, let's say, 10 cents per kilowatt hour additional to what you are currently paying on your bills, to make certain changes to the system that will make it more flexible and more resilient. Is that going to be beneficial compared to the fact that in many countries the value of losing a kilowatt hour of electricity is probably $78 US cents. 78 US dollars. So do you spend 10 cents, 10 US cents, so that you maintain $78 of GDP for each kilowatt hour that is produced? And these are the kind of questions that we typically ask.
No, fair point. But let me take you a little bit more into the conversation, because part of the reality is this, based on what you have been saying thus far, it seems to me highly unlikely that rates that in recovery, that the rates of electricity in Jamaica will have to go up, or likely to go up. And I'm curious, how does that dovetail with the express statement from the government of Jamaica that they would that in the renegotiation of an electricity license, one of the things that they're putting squarely on the table is that the electricity rates must go down. Now, the two can't be congruent.
Well, there is a lot of it has to do with what is in the resilience fund? I mean, I haven't looked at it, to be honest, because remember, Jamaica has this kind of rainy day, if you want to call it, charge that they have on the current tariff. There's a small amount of the current tariff which goes into our resilience fund that based on the current rate structure. So when there are no hurricanes and disasters, there's money being set aside by the OUR, by you know, in the rate base, so that there is a fund that is created to do some of this recovery. I don't know what the full extent of the fund is in terms of how much money is available here, but I doubt it will be sufficient to do the kind of restoration that is necessary because of the significance of damage that has been effective. Now, some may argue that with force majeure, with a force majeure declaration, aspects of the of the catastrophe bond and the payouts of it from insurance should probably go into the power sector infrastructure to minimize the impact on tariff. It's up for debate. The point is, at the end of the day, do you treat the grid as a public good, or do you just simply treat the grid as a straight investment? If you treat it as a straight investment, then obviously everything that goes into the grid in terms of capex is going to come up from what you collect from customers. When you collect it through the resilience fund, you collect that, save it in a resilience fund, and then spend it in a lump sum along, or you recover some of it in the future rates. So that is the thing. If one is in the resilience fund now, can only pay a certain amount of the costs related to this recovery, obviously the utility will have to recover the rest from future rates, and therefore there would be a natural increase. The question is, does the government perhaps look at whether there should be a portion of the insurance, the catastrophic bond insurance, and the other parametric insurance payouts that go really just like you do with roads and other infrastructure, other basic infrastructure to the power system, and that if that money goes into some of the grid recovery, if you want, restoration, then then obviously the regulator would ensure that that investment does not form part of the rate base, and then that would minimize the potential impact of some of the restoration and the ratepayers. So there are ways of doing it that are creative. But obviously in my mind, if there is not going to be some capital injection that is external to the utility investors, it's impossible almost to avoid a rate increase.
Wow. But the thing is that because we have heard, and it has been validated from the prominent secretary in the Ministry of Energy, Ms. Carol Palmer, heard her on some media platform. There just confirmed that the JPS has now requested, or say we're seeking to get some sort of extension on their license to accommodate them raising additional funding to treat with some of the hurricane damage. Again, if that is granted, all right, let me ask you this way. What are the real options the government has in this sort of dynamic? Because if you extend the license for them to be able to raise these funds and repay it within a specified time, then it would seem to me that the status quo is going to remain in place, frankly. Or if you don't, if you say you're not extending the license, the people will say, well, they are unable, given the limitations in terms of time for the license to expire, they will be unable to fulfill that aspect. So where does that leave all of us?
Yeah, I agree with you. The timing could not have been worse in terms of the situation with the license and the investments that is required, not just for the recovery, but for the rebuilding of the system. Not just for the restoration, because there's a lot of investments that going into the restoration, but then the full recovery, including rebuilding. If we are talking about just the restoration, then I would imagine that significant portions of the restoration could be paid for especially with the resilience fund, and probably recovered between now and the end of the license. But if we really want to get the kind of if we want to call it recovery that we are talking about, the building back better kind of things that we are asking for there to be assessments and undergrounding of some cables and strengthening of some substations, raising the height of some substations that are coastal, as a case in point, to avoid storm surges, strengthen the structures and reinforcing structures, rebuilding in some instances some of those that have been significantly compromised, putting in the kind of ICT and the kind of digital technologies that will improve intelligence and make the system a lot more flexible and better and more manageable, especially by putting in greater amounts of redundancies and greater amount of intelligent and smart decision making. It's not something that would be payable over to the remainder of the license period if that investment were to be made. So it makes sense that if the government is going to insist on a minimum level of investment in the system that is, close to optimal, certainly better than suboptimal, then the utility would need to raise that money from its investors or from its from loans or from capital markets. And in order for the utility to raise that money, the utility would need a license that's credible in terms of the time frame that it would it would hold that license for, because those monies are not monies that could be paid back within the rest of the term of the existing license. But the government does have the ability to extend the license, but with some amendments. I mean, amendments that do not necessarily affect the core function and business of the utility. For instance, there's the right of first refusal, or the ROFA as we call it, for the existing generation that is held by JPS. Government can amend the license in such a way that says, look, for the ROFA generation that you have, you are obliged to use renewables if it is that we are looking to shift towards renewables. But then again, there's also the conversation around renewables. You would have heard what I said about the solar farm earlier.
Right.
I am a proponent of renewables. But, there's a downside of renewables, especially in respect to solar facilities, because a solar facility that is hit by a Category 5, it's almost impossible that it will be able to stand up completely. I remember last year in Grenada, doing an assessment on one small solar facility in Limnir, which was hit by Berilla, which was a Category 4 when it hit. And 90% of the panels and about 70% of the racking systems were damaged. And I remember the conversation I had 10 years ago with someone who was, if you want to call it, one of the solar naysayers. And he said to me, Devon, if you want to build resilience, build a diesel plant, because you can just lock the plant up when there's a hurricane and open it up back when the hurricane passes. If you put solar farm, then you'll have to walk up and down and pick up panels. And that was what he said to me.
Yeah.
And you really have to, everything that you do in life is going to have to be a trade-off, because solar PV farms are out there, stretched out in the middle of the natural environment, daring the wind to come get them. So it definitely is a higher hurricane risk. So if government is going to say to JPS that you're going to have to move in that direction, then there would have to obviously be the conversations around how do you ensure that there is sufficient, insurance? Does the government seek to work with the utilities to build some kind of self-insurance scheme that can protect some of these, these systems in the event of damage from the hurricanes and so on? Because I can tell you that the insurance for solar PV systems, for insuring them against hurricanes in the Caribbean, is not cheap. I was working in one instance with a government in the Eastern Caribbean, and when we looked at the numbers for insurance for a relatively small system, around 20 megawatts, we were, the numbers were $1 million US per year. And that was coming out to probably, over the life of the system, 20 million was coming. It was a system with battery, of course. Right? It was a $80 million US system when by the time you put the batteries on it, and so that was the insurance was coming up to around 25% of the total capex of the system. So it's not cheap, because the truth is that it's a real risk, and those who are in the business of insurance are going to charge you for the premium, charge you a risk premium. So, so if there can be some mechanism that government probably works through with, self-insurance arrangements, it might make it cheaper and more manageable. So it's not an easy fix. It's not an obvious fix. There will have to be some amount of analysis that we have to spend to do. The thing about the licenses that in its current form, as I mentioned, government had signaled that it wasn't intending to renew the license in its current form, but it was going to make structural changes that would have, based on where we saw it going, we expected that the license would have been disaggregated. So you would have been moving from the vertically integrated utility to a much more, if you want to call it, segmented power sector. Now, with what is going on, if the license is extended, you would still probably end up promulgating the vertically integrated utility. But as I mentioned, there is still the opportunity to make some amendments and adjustments that can keep some things that are not critical to the core functions of the utility, in balance. So you still get some changes while keeping the core intact.
Okay. All right. Quick question for you. Come on, we have about 2 minutes left. But quick question for you. Who has the handle and who has the blade in this discussion? Because
between the utility and the government?
Between the utility and the government, who has the handle and who has the blade?
The bottom line is you do need a utility to function as a country, right? And you have a utility that is existing, and you do have a utility that is operating in a crisis mode because of the situation that we would have faced. You don't normally change your general in a crisis, in a war. No, you don't usually get rid of your soldiers in a war. I guess in this instance, there's going to be there's going to be very little that government can do right now to really, change the license or change too much within the license regimen, given what is happening. So if you're looking at it in that sense, the one who holds the license is better off in the short term. But in the longer term, it's always government that decision. So, so longer term government will always determine how the license goes. But for the short term to maybe medium term, JPS, this helps JPS to pretty much, negotiate its license.
All right, Devon, I have 30 seconds. A quick question for you. If you were to have a crystal ball, and then if an extension were to be granted to this license, for it to be realistic with all the calls for additional financing, etc., what length of time would we be looking at realistically for such an extension?
If you're saying that 3 billion in infrastructure damage, and if that 40% of that is from the utility power infrastructure, then you probably, and then you want to do some amount of, if you want to call it, improvements to the existing power infrastructure. So you're looking not just at the 40%, we're going to look at that plus. You'd say 10 years. I would say a 10-year extension would be what makes sense.
So in other words, if we're not careful, the status quo will basically remain.
That's the case, Joseph. A hurricane normally sets you back, 5-10 years, right? Yeah. So it's understandable that that a lot of the things that we would have planned to do had there not been a hurricane, that we'll have to change our timelines. So I think that 10 years would be reasonable if we are expecting the utility to make the investment. If it is that the investment is going to come externally, then you can shorten it. If there's some public good treatment of aspects of the investment, GCF or any of the climate adaptation funds are going to be breached. And I use the term breached because they don't like to treat power sector infrastructure as an adaptation issue. They like to treat it as a straightforward investment that has to be paid back through loans and the collection from rate paying off those loans. Then that's how GCF tend to treat power sector issues. Unless they treat the power sector as a critical, as a public good, as a service to citizens. We are going to have to look at it through a straight investment lens, and that straight investment lens, I say no less than 10 years. I would say 10 years.
Well, on that note, Dr. Devon Gardner, Senior Partner for the Institute for Innovation and Growth. We have to leave it there for today, but I thank you, sir.
Thanks a lot.
Good. This is your Market Watch on the Caribbean Business Review. I'm Joseph Cox. We begin in Jamaica, where inflation rose 0.7% in October. Point-to-point inflation stands at 2.9%. Still in Jamaica, the Bank of Jamaica's Financial Policy Committee says the financial system remains stable, liquid, and well-capitalized. Stress test shows banks and insurers can absorb the expected rise in credit risk. And the National Reconstruction and Resilience Authority has activated a $1.15 billion US liquidity package as Jamaica begins its 5-year rebuilding program. Damage assessments now total $8.8 billion US, the costliest disaster in the nation's history. Meanwhile, Fitch Ratings has revised Jamaica's outlook to stable, affirming the BB- rating, but warning that fiscal balances will slip into deficit and debt could rise towards 68% of GDP by end 2026. Turning to the wider Caribbean, in Barbados, government revenue exceeded targets by $373 million, driven by strong VAT and record-high corporation tax receipts. In Turks and Caicos, a new contractors bill will mandate 60% belonger ownership, annually renewable licenses, and new tiered fees. In the Cayman Islands, the government plans to raise $172 million through higher fees on financial services developers and non-Caymanians. In Bermuda, regulators have strengthened travel rule compliance for all digital asset transfers ahead of the island's major FATF evaluation. In the Eastern Caribbean, Grenada has amended its Fisheries Act to avoid a U.S. import ban, safeguarding 6,000 jobs. And the CDB has raised 100 million Swiss francs in a new sustainable bond to fund climate and food security projects across the region. Guyana has launched its first national agritourism policy, and Bermuda expects 193 cruise ship calls in 2026, up 13 sales year on year, even after storms forced 20 cancellations in 2025. We now turn for a quick look at today's regional markets. CARICOM currencies were broadly steady, with the Jamaican dollar trading at 160.65 and the TT dollar at $6.80. The Barbados dollar maintains its long-standing peg at $2.03. On the equities side, performance was mixed across the Caribbean. The JC index slipped 0.45%, while Trinidad's All TNT index gained 1.08%. Barbados edged slightly lower, and both Bermuda and the ECSC held flat. Top gainers included Epley 7.75% preference shares, up 17.6%, and Kingston Properties, up 8.99%, while Sagicor's Real Estate Fund down 15.27%, and MPC Caribbean Clean Energy down 15% led the declines. So that's it for your Market Watch. I'm Joseph Cox. Global Pulse is up next. This is CBR. This is Global Pulse on CBR. We begin in Asia, where Japan has posted its first GDP contraction in 6 quarters. The economy shrank 1.8% in Q3, hit hard by new U.S. tariffs that drove a steep decline in auto exports. Nonetheless, exports rose 3.6% overall in October. Tokyo is preparing a 17 trillion yen stimulus package, even as inflation at 3% keeps pressure on the Bank of Japan, which may still move towards a rate hike in December or January. Across the region, Singapore has upgraded its 2025 growth forecast to around 4%, following a stronger than expected 4.2% GDP outturn in Q3. Turning to Europe, the EU has adopted a sweeping overhaul of its visa-free suspension regime. Meanwhile, Eurozone business activity held steady with the composite PMI at 52.4, marking nearly a full year of expansion. In North America, Canada's inflation cooled to 2.2%, driven by sharply lower gasoline prices and softer food inflation. Retail sales were soft, down 0.7% in September, while home sales rose 0.9%. The U.S. outlook is mixed. Payroll data shows 119,000 jobs added, but the unemployment rate climbed to a four-year high of 4.4%, with economists citing AI adoption and tariff uncertainty as key headwinds. Manufacturing PMI slipped to a four-month low, with new orders softening and inventories hitting a record high. The CBO now estimates that Trump's tariffs will reduce deficits by $3 trillion through 2035, down from a previous $4 trillion estimate. In emerging markets, India's trade deficit has hit a record $41.7 billion, driven by slumping U.S.-bound exports on the new tariffs and a surge in gold imports. Finally, in global commodities, China has now booked its largest U.S. soybean purchase in more than 2 years, 1.6 million tons in 3 days, after the Trump-Xi meeting. But analysts doubt Beijing will reach the proposed 12 million ton target by year end. Turning to the markets, oil prices softened across the board at the weekend, with WTI down 1.7% to $57.98, Brent slipping 1.4% to $62.48, and the OPEC basket edging down to $64.54. Natural gas moved in the opposite direction, jumping 2.35% to $4.58. Global equities were mixed. U.S. markets led gains with the Dow up 493 points, the S&P 500 up 0.98%, and the Nasdaq rising nearly 200 points. Europe was steady, but Asia saw sharp declines. Japan's Nikkei fell 2.4%, and Hong Kong's Hang Seng slipped 2.38%. Now that's your Global Pulse. I'm Joseph Cox, and this is CBR. Well, folks, that's a wrap on episode 11 of season 2 of the Caribbean Business Review. Now, thank you so much to our loyal audience across MKR Radio and all digital platforms for your continued support. As always, we live by our mantra: knowledge is strength, but information is power. A special thanks to our guest, Dr. Devon Gardner, Senior Partner at the Institute for Innovation and Growth, for his strategic insights with respect to rebuilding the power grid in Jamaica after Hurricane Melissa. What are some of the key takeaways? Jamaica's electricity grid suffered catastrophic losses, with power infrastructure alone accounting for roughly 40% of an estimated $3 billion in national damage, highlighting the grid's vulnerability and the urgent need for long-term resilience investments. 2. Post-Melissa recovery requires treating the electricity grid as a public good with government utility cooperation, regulatory flexibility, including possible 10-year license extensions, and a clear financing framework for modernization, not just restoration. And 3. Undergrounding and other resilience upgrades are economically complex decisions, but delaying them risks repeated setbacks. Every major hurricane pushes Jamaica's grid development timeline back by years. Now, remember that our new CBR Intelligence notes drop every Wednesday, providing deeper midweek analysis on the biggest economic and policy issues across the region. Also, remember that you can listen to this broadcast at your convenience on Spotify. The latest edition of the Caribbean Financial Dispatch is live on LinkedIn, WhatsApp, and linked in the YouTube comments. To subscribe, email us at caribbeanbusinessreview@gmail.com. Don't forget to like, share, comment, and subscribe, and follow Caribbean Business Review on TikTok, Spotify, YouTube, Instagram, X, and LinkedIn. Until next week, same time, same place, I'm Joseph Cox, and this has been CBR.